So just to let everyone know, we are recording as of now. I'm obviously so today, as you can kind of see, we're covering chapter 9. Um, yeah, last time we wrapped everything up and we didn't get a chance to start with chapter 9. According to the schedule, we're actually ahead of schedule. Um, as you can kind of tell, here's the schedule that we have. Today we were supposed to finish up forming and operating partnerships. We've already gone ahead and done that. Um, We're going to do chapter 9 today. Thursday, my goal is to have the exam ready for dispatch to you guys by Thursday. And then what I'm going to do is that instead of having a traditional class where we focus on, this is what you need to know for the exam. It's basically going to be, here's your exam. And basically what's going to happen is I'm going to give you some pointers on how you answer it. The exam, I'm probably right now about 75% complete with it. But the way the exam is going to be done is that it's going to be almost all short answer. I've had mixed reasons. I mean, I've had mixed reactions to that in the past. The exam traditionally, if we were still in a regular classroom, I would still probably organize the exam kind of the way that I'm doing it here. The exam, because it's going to be a take-home exam, and we're going to have various methods that we're going to be able to use in order to solve them. What I've decided to do is that it's going to be primarily code focused, but it's also going to talk about a lot of the various things that you need here. And let me begin by start saying a few things. So first of all, in your classrooms, when you're taking the actually, let me step back. So when I took a look at this class many years ago, and I first started designing it, the biggest thing that I really wanted to do was to give you guys a lot of the tools, the methods, and things in order to be successful in what you need to do. And there's a little bit of a disconnect there. As I've said 100 times, I say it to my interns here. I say it to my students. It's pretty much been the same method. The best piece of advice that I got from a colleague of mine, and I say colleague, he was actually a partner, but he was I think it was 2 years younger than me, which was kind of an interesting dynamic. When I went to go work at Thomson Greenspan, he sat down with me. He said, "Look, Kevin, let me tell you how you succeed in the accounting world. When you start off as a staff, your primary job number one is how do you learn, learning the software. Once you understand how the software works, and we see that you've been able to do that, you will be advanced to the rank of senior. In order to go from senior to supervisor, because Thomson Greenspan, what they do is they started off as your staff, then you move to senior, and then you go from senior to supervisor, then supervisor to manager, and then from manager you actually go straight to partner. They didn't have a senior manager or a director role, and part of the reason for that is because Thomson Greenspan only has 50 CPAs and employees working for it, so there really wasn't enough need to have multiple layers of promotion like that. Now, another firm that I worked at, Gelman Rosenberg Friedman, they had probably about twice the number of CPAs that Thomson Greenspan had, and they actually did have the senior manager and then what they called the principal. Now, what a principal was somebody who maybe what had happened is they bought their firm, and so instead of bringing them in and making them a full-blown partner, because all they were doing was just buying the firm, bringing the clients in. What they did is that sometimes they would cut the deal with the individual they're buying the firm is, look, we're going to bring all your clients in, and then we're going to make you a principal. We're not going to necessarily make you a partner. And I think some of that had more to do with two factors. Number one, and this really gets a lot of inside baseball, but I wanted to give you guys kind of this background information in order to kind of better understand it. There's actually, most states have strict rules as to who can be partners in CPA firms. And part of the reason for that, it has nothing to do with tax, but it's actually more on the audit side. Because what happens is with CPA firms generally, in each state, in the union, no matter which state it is, all 50 states pretty much do this. The only person who can perform compilations, reviews, and audits are going to be CPAs. You have to have the three-letter designation after your name in order to be able to sign the engagement letter and sign the audit and audit review or compilation report. As a result of that, in order to prevent sort of some shenanigans from happening, they actually limit who can be partners in CPA firms up to certain points. Now, various states have different rules. Some states have it where it's 100%. You have to have 100% of the firm has to be owned by CPAs. And if it's owned by anybody other than a CPA, you can't do audits, reviews, or compilations, even if you have the three-letter designation. And that comes down to sort of the peer review process, because the peer review process is not, does your employee have the ability to do what is necessary in order to perform the compilation? It's, does the firm have everything that is necessary in order to be able to do the compilation, review, or audit? And so as a result of that, what they've done is they really manage that. And so some firms, some states, like I said, it's 100% ownership. Here in the state of Virginia, it's required 51% or more of the controlling slash, I think the way it's worded is 51% of the voting power and value of the partnership must be owned by CPAs in order to be able to do reviews, compilations, and audits. And so sometimes what happens is that when you're going to buy a tax practice, you'll have some people who have just been doing taxes for 30, 40 years. They're smart, they know what they're doing, but maybe instead of being a CPA, they're what's called an enrolled agent, an EA. So if you have an EA that's part of your ownership, it can actually throw your organization for a loop and prevent you from maintaining the compliance necessary in order to be able to do audits, reviews, and compilations. And with most CPA firms, most good CPA firms, half of your audit fees are going to be done through audit, and about half are going to be done through tax if things are done correctly. Some firms, very good example, Beta Solutions. I want to say, I'm kind of doing some quick chicken scratch here. Let's see, I think we're at 20%. Yeah, it's 20% ish for audit fees versus everything else. So we were very tax focused, very heavily tax focused, but at the same time we're also very heavily focused on trying to build that audit compilation and review practice. And so what ends up happening is that there's strict rules that we have to maintain. And so when you buy a practice that is, say, predominantly tax, maybe the owner doesn't have a CPA. Maybe they've just got an EA. Or actually, I just met the lady who actually is in the office, two offices down. She never took any of the exams. But she's been doing taxes and bookkeeping work for people. So I think I talked to her. She set her practice up originally in the late 80s, and as a result of that, she didn't need the CPA in order to be able to do that. Now she can't do, like I said, she can't do the review, audits, and compilations. That said, it doesn't mean that she's incompetent in what she does. Maybe we buy her practice, we bring her in, but instead of making her a full-blown partner, we make her a principal. So a lot of firms, if they have principals, it's going to be a way that they can actually come back to them and say, look, you're not a CPA, we'll make you a principal. Now, KPMG, very good example. I had a partner that I worked for. He technically wasn't a partner, he was a principal. And the reason was he didn't have any certifications either. He was one of the last people to get promoted to the area of leadership. And back when KPMG in the field that we call Global Mobility Services, now it used to be called International Executive Service, but back then you didn't have to have any certification in order to do it because it's just individual taxes. And so he's phenomenally smart, knows, probably forgotten more about tax than I know. But at the same time, didn't have the certification, so they can't make him a full-blown partner because it jeopardizes that the opportunity for them to continue to do the reviews, compilations, and audits. Um, some firms, Thompson Greenspan is a very good example. Principal is a stepping stone to go from manager to partner. So you'll go and you'll be a principal, and you're sort of a partner in training. And once you've done one, and usually what happens is, as a manager, you're not responsible to go in and get clients. Your job as a manager is pretty much to manage the entire preparation review process and make sure everything's ready and good to go so that the partner can take a look at the return, say, yep, I totally agree with everything that you guys have done, sign, move on. Okay. Usually they don't allow non-partners or principals to sign tax returns in most cases. And Thompson Greenspan is one of those. I remember when I was there, Tom Cotton, who was the managing partner for Thompson Greenspan, gosh, I want to say it was up until about 2011. Smart guy. He and I got along very well. I really liked him a lot. We had lots of deep discussions about taxes and how it affected people and things of that nature. But he had retired, and so in his retiring process, he sort of stepped down from a lot of his duties and was turning over a lot of his clients over to other partners. Primarily to one partner who was the head of the tax department, because at that time there were only two people who were in leadership. There was one who was a partner, one who was a principal. Later on, that principal would become a partner, but Tom Cotton's clients oftentimes were being transferred between Tom Miller, who was the partner, and then Sean, and I'm forgetting his last name right off the top of my head, but they were giving him a lot of those clients because he was getting ready to become a partner. But the thing is that when he turned some of his stuff over, a couple of his clients really didn't want to work with Tom or Sean. There was another person who was there who was a manager. They really liked her, and they wanted her to be the person that was taking over his stuff, even though she had vehemently said, I don't want to be a partner. I don't want to be a partner. I don't want to be a partner. So they gave her signing authority just on a few returns. And oftentimes that's basically what will end up happening. People will have designations to be able to sign returns. Certain people will have designation in order to be able to be the final person to prepare that return. And so what ended up happening is that those individuals, usually when you're going from principal to partner, it's because you're building your book of business, that once your book gets to a certain sufficient size, you will then step down from principal and move into the partner role, because the thought is that you make enough money for the firm. Now, why am I bringing all this stuff up? When I sat down and I built the class, I came to the realization that they really wanted people to talk more like managers. In other words, and we call them code heads. Code head is a term for an individual who, keeps talking about the code all the time. Code section 179, code section 168, code section 465. And part of the problem that I saw with that is, if you were a staff and you were doing code section talking, it was very unusual. Most of the time, you're so busy still trying to figure out what happens in the firm and how it works, and then at the same time, you're also trying to go into really just kind of learn how to use the software. And the problem is that you could be a sufficiently knowledgeable person about the code, but because you don't know about the software, sometimes people are more judging on your software knowledge than they are on your code knowledge. And now the thing is, how do we solve that at this firm? In the university system, it's a little difficult. And part of the reason why it's a little difficult is I don't know what software your company is going to want you to learn. Are they going to want you to learn Pro Series? Are they going to want you to learn GoRS? Are they going to want you to learn UltraTax? Are they going to want you to learn Lacert? I don't know. I can't predict where you're going to go work, and because there's roughly about 8 to 10 different software packages out there, it's impossible for me to sit down with you and say, this is how you build a tax return the first day that you get to class, without really there being a significant amount of foresight knowledge as to what you're going to do. And I can't do it based off the popularity of the software package because all of them are really popular. I mean, Pro System, for example, is very popular because it's one of the best products out there, as is GoRS. But GoRS and Pro System each run at the very minimum $10,000 to $15,000 in order to buy. So most small firms aren't going to spend their money on that kind of software package when you can go out and you can buy Access. You can also buy Ultratax. Ultratax generally runs about $3,000 to $4,000 if you get the full package plus some of the states. So there's just this huge disparity, I guess, in terms of what kind of software you're going to be able to get. So it's very difficult for us to be able to do that. So when I sat down and I was organizing this class, the first thing I said is, what does a staff need to know? What do staff really need to have a good understanding of? And some of the stuff that they need to have a good understanding of is tax forms. There's certain tax forms that you need to be aware of and how a lot of those forms get done. And that's what we've done in this class. I've shown you K1s, I've shown you 1065s to 1120s. Traditionally in the past, you would actually build tax returns with hand. I tend to shy away from that. Just because of the fact that I mean, you're never going to build a tax return by hand. I only know one person who has traditionally done tax returns by hand for anything other than an individual return. And that person is because he doesn't want to hire a CPA firm to do his tax returns. He spends probably around $25,000 on audit fees and figures that, to build the tax return, there's just no point to it. I'm hoping to change his mind on that here soon because he's a client that we hope is going to be more willing to do that. But the fact of the matter is that most of the time you're not going to build it that way. So I felt that if you have the access to the forms and then you have an access to the processes that we use in order to build those tax returns, that's more valuable. And today's class is going to be absolutely no exception. We're going to talk about, first of all, that's my GovCon meeting, which I haven't gone to since I've started teaching because it's always on Tuesdays. But here's the thing. Income deductions and accounting methods. Accounting methods are very important, and part of the reason why they're important is how we do the accounting methods is really going to drive how you actually prepare the tax return. Okay, this is a question you have to ask yourself every time before you start the tax return. What's the accounting basis of these clients? And so, in very good example, if I'm dealing with, I'll give you an example of one of my clients that I have here. He's a small businessman. He works as a contractor for various IT companies. And so what happens is that, they'll hire him in to do a couple projects and then he makes money off of that. Now, we went ahead and we elected him to be an S corporation. So obviously, he's an LLC. We went ahead and we elected him to be an S corporation, which is an accounting method that we can use. It's a tax accounting method that we can use. And then the second thing that we ended up doing is that we had to ask the question, do we want him to be cash basis or accrual basis? And the answer is that for him, we wanted him to be cash basis. In his case, it didn't really make much of a difference because whether he recorded the income this year or next year, it generally is going to be the same amount of income regardless. And so you can't have a situation where you're, where you're taking a look at all this and it just made more sense to do it on a cash basis. Plus, he doesn't have any fancy dancy accounting software. Basically, what he does is that he hands me an Excel sheet that says, this is how much money I spent on everything. And so we just kind of put together a trial balance for him on that. And you'll have some clients that'll do that. Here's my Excel sheet. This is what I spent on my business. You do the cash. We've talked about it with the example where we have, let's see, I think it's this sheet right. No, I did not do that. I thought I had that up. Give me 1 second. I thought I had it up. Example TV. So essentially what we do with him, where we take the trial balance that we have here. This is our example trial balance that I've shown you guys in the past. Whoops. Oh, I went, no, actually I want to make that a little bit bigger. All right. So we've done this where we've had, the list of their cash assets. And we did this sort of thing where we were kind of fixing the stuff that they were giving us. Sometimes what happens is your client's adjusted trial balance is zero. And so what will end up happening is that they're just going to say, here's all the money I spent. Here's all the money I received. Build me a trial balance so that you can build my tax return. Usually what we do is cash disperse. We take all expenses as cash outflow. We take all income as cash inflow. And then we ask him for a copy of his bank account, at 1231. And then what we do is so adjusting journal entry 3 or 1 would be income in, cash in. Adjusting journal entry 2, expenses out, cash out. Adjusting journal entry 3 will be whatever balance needs to be done here in order to balance it to cash. Now you might say, well, where else do we put the rest of the money? Well, if it's a cash outflow, we put it to distributions. If it's a cash inflow, we put it to contributions. Generally speaking, what's going to happen is it's not going to be a cash outflow, it'll be a cash inflow. And so we try to get that to where it actually balances out to the bank account. If the client makes less than $250,000 and they're a corporation return, you don't have to worry too much about it because you're not going to report them on Schedule L or M1 or M2 anyways because you don't have to. M1s and Ls and Schedule Ls are not required if the client is making less than $250,000 or has less than $250,000 in assets. So those are the types of things that we're going to do. But we're also going to talk about business income deductions. These are just some general things that you need to understand about some of the deductions. And then we're also going to talk about change of accounting methods, Form 3115. Okay, so business income deduction, Schedule C. Schedule C is going to be your income income tax form that you're going to use if you have a sole proprietorship or an LLC that's single member. We call them disregarded entities, or sometimes they're also referred to as tax nothings. In other words, as far as the IRS is concerned, they don't exist, so they're tax nothings really. For Schedule C, you're going to include revenue from services, gross profit from sales. You may have a cost of goods sold. Now, I will tell you right now, you need to understand that cost of goods sold is only going to exist in a business where you have inventory. And I mention this because I can't tell you the number of times that I get a Schedule C prepared by another firm where the person does consulting work and they have cost of goods sold. There's no way that you can have cost of goods sold on a consulting business. By definition, cost of goods sold. In other words, the only thing you're selling is your brain. So unless you're going to tell them how much you spent to build your brain, it doesn't work. And I've had some times where I've had to fix that. And I've had some difficult arguments with some clients because they said, wait a minute, my CPA in the past always used cost of goods sold. And I'm like, yeah, let me show you the definition of it. So we sometimes have to do that. Business income does not include excluded or deferred income. So if, for example, you can do an accrual basis Schedule C. But it's almost like pink unicorns. We never see them. You hear about them, but you never see one. And that's kind of the way that they do sort of Schedule Cs that are accrual basis. But if you take a look at a Schedule C, there is a box that you can check that says, "Hey, I'm going to go ahead and I'm going to do an accrual basis Schedule C." Again, it's like pink unicorns. You'll never see it. I've talked to CPAs who claim they've done one, but it's like a rare thing. That, and then deduction must be directly connected to business activity. Ordinary and necessary. That is a very common term, and that term actually comes from Code Section 162. Well, Code Section 162 will actually talk about what is ordinary and necessary. That is a very important term. They also have to be reasonable in amount. In other words, if I go to the local, so a very common example that I use this in my class. If I travel to Las Vegas in order to participate in the CPA, an AICPA conference, and by the way, they do exist. Every year they're always asking me if I want to go. It's like $1,000. You spend an entire week there. You're in the hotel the whole time, so obviously we know what happens in Las Vegas when you're stuck in a hotel the whole time. Most people are going to go gambling, and they're going to enjoy themselves and have fun. But it can't be unreasonable. In other words, I can't go to the presidential suite if I'm an accounting firm that's making $350,000 a year. Because if it's not reasonable, what will happen is the IRS will lower your business deductibility for that expense to a more reasonable amount. And if you take a look at a Schedule C, and I'll see if I can pull one up here real quick. That one. All right, so if you take a look at the Schedule C, there's a few things that you're going to see are going to be bifurcated out. And bifurcate, for those of you who don't know, that's what we call in the accounting industry the $3 word. It's one of those things that you can kind of throw around, and it makes you sound like you're a really smart guy. Bifurcate. Bifurcate just basically means to split. But you'll see a few things that are actually split out. And so one of the things that they do is contract labor. Why do they do contract labor? Because if the IRS wants to verify how much you spend on contract labor, they're going to go pull up your 1099s. And if your 1099s don't equal what you put in contract labor, they're probably going to want to ask you for it. Another example, interest. Interest paid to mortgage banks. If you're going to record that you spent X number of dollars on interest, they're going to go pull up your 1098s as assigned to the business. Figure out, did you really pay that interest? And if you didn't, they're going to want to ask some questions. But a big one that they have here is travel. Now, we haven't gotten to this point yet, but there's two different types of expenses. One is general substantiation, and one is specific substantiation. General substantiation are things that don't, you can justify them in gross, but it's very, very difficult to be able to prove per unit that you used it for business. A very good example of that, this is a piece of paper. I won't obviously show you the front of it, but this is a piece of paper that I printed out. It actually has, it's a status report of all my Virginia tax returns, because we're trying to get as many of those guys out this week as possible. But the IRS isn't going to walk in here and say, show me every single piece of paper that you had that's for business. That would be ridiculous. There's no way they're going to do it. Now, there's certain industries that they're going to say, you're an accounting industry, we expect you to use a lot of paper. And so they're not going to question when you tell them I went out and bought a whole bunch of copy paper for my printer. They're going to be like, okay, you're an accounting firm. Duh. It's like saying, a marine biologist said, I bought some water. Well, okay, yeah, I mean, you're a marine biologist. Of course you use water. Things of that nature. So there's some certain things within reasonability that they're not going to do. Now, if I'm a car mechanic, and if my copy paper budget is equal to that of a CPA firm, might want to ask some questions about that. Car mechanics don't have to print a lot of that stuff. I mean, there's some paper they have to use, but oftentimes it's specialized paper for invoicing. But for the most part, this isn't. It's not an expense that they would expect to see. So it would not be reasonable for you to have an exorbitant amount of money that you have for paper. And so that's kind of the thing that they do here. Now, the other method that they have, general substantiation, they also have specific substantiation. Specific substantiation falls into three groups: travel, meals, and mileage. Those are the three. And those are the ones that the IRS will tell you, hey, you told us you spent 10 miles driving to go get this one thing done. I want to know the name of the person you were with. I want to know why you were with them. That's what they're going to ask. Now, according to the IRS rules, and if you take a look at it, there's actually a RevProc that they put out, RevProc standing for Revenue Procedure. And they mention specifically, you don't have to have a logbook of your mileage. However, you have to be able to substantiate everything. Well, how else do you do that? I mean, there's just no other way to do it. And so one of the ways that most of my clients do is that they'll have, when I worked in the government, the federal government, every company car had a binder that was in it, and every time we did a business trip, you had to write down, I'm driving from here to there. Here's the start odometer. Here's the end odometer. How many miles were used? Why was I doing it? The government's going to expect the same thing because the IRS uses the same methods. That's actually a federal government requirement for all government vehicles. And so what'll happen is that they're kind of expecting you're going to do the same thing. And so that they'll expect that. Travel, if I go to a Las Vegas conference and they notice that my hotel bill is 3 times the average of people who go to Las Vegas, they're going to ask, they're going to straight up ask me, why, how much, why, prove to us this bill. Show us the bill. Oh, you got the presidential suite. Are you someone special? Is there a reason why you had to have the presidential suite? Now, if the entire hotel was booked and there was nothing you could do and you had to be in the presidential suite because that's all that was available, different story. But you would have to have documentation that says, look, we were booked on that night. And to get that's not difficult. You can go back to the hotel and you can say, hey, look, you guys forced me to be in the hotels, in the presidential suite. Can you give me a letter that says you guys are totally booked that night? And they'll be like, yeah, sure, we can do that. And they'll usually help you out. Try to get, if you're forced to do something extravagant like that, my recommendation would be to get a letter ahead of time. And most of the time, hotel managers are willing to do that. They understand why you're doing this. And so those are just kind of the things that we have to take into mind when we're dealing with this. Not going to look at this. So statutory limit sum on returns. Expenditures against policy, obviously fines, bribes, lobby expenditures, political contributions. Some of you might say, well, bribes, of course bribes are going to, bribes are illegal. Well, yeah, but which country are you in? There's certain countries where bribes are not only not illegal, they're customary procedure. Now, there's also some laws that we have on the books here in the United States that basically say, yeah, we understand that if you go to a country, and I'll just pick some country in Podunk, where bribes are generally accepted and required. If it's a bribe and you pay it, you still can't take a deduction off of it. In fact, you could be held legally liable as a U.S. citizen if you are participating in activities that the United States says is illegal. So, for example, human trafficking. If you're going overseas and you participate in activities that are linked to human trafficking, you can be thrown in prison just like anybody else here in the United States. Yeah, you could say, well, under the laws of country blah, it's perfectly legal. They don't care. They'll throw you in. Personally, this is actually a law I kind of agree with. You shouldn't be participating in human trafficking, period. End of story. I remember this was a major topic when we sent military people overseas, because what would happen is that you get into the country and there's certain laws that you're telling you're gonna follow, but at the same time we want you to follow the higher guidelines that we have. You're not going to participate in that stuff. Lobbying expenditures. If you're going to pay a congressman to take care of your business, you can't deduct that as an expense. Political contributions. Generally, political contributions are non-tax deductible. Some states will allow you to do it, though, if you donate to a recognized party. So a very good example here in the state of Virginia, I think if you donate to the Republican or the Democrat Party, they will let you take a deduction off of that on your state tax returns. But you can't take one. But it has to be the party itself. Can't be to the candidate. So you got to be very cautious about that. Expenses related to tax-exempt income. So if you make money on tax-exempt income and you have expenses, interest on loans or proceeds or invested in municipal bonds, you can't deduct that, which makes sense. If you're borrowing money to make tax-exempt money, IRS isn't going to allow you to have a deduction for that. So that's pretty simple. Capital expenditures. Sometimes what will happen is that a very good example that we see with a lot of our rental real estate properties. They'll come to us and they'll say, hey, look, we spent $15,000 on repairs last year. And usually if you see a repair number on a rental property that's more than $2,000, I start asking for a breakdown. And part of the reason why is because if you replaced your windows, that's not a repair, that's a capitalizable expense. So what will happen is you pull that out of repair expense, you capitalize it, and you depreciate it over the required time. In Windows case, it would be 27.5 years. Personal expenditures. If I'm going to Las Vegas uh, in order to participate in a conference, but I decide to take 3 days in between the conference and going home to go do some sightseeing, I can't write all that stuff off, and I think that's pretty understandable. And then business interest limitation, Code Section 163. This is a brand new code section limitation that was put in under the new Trump bill. It limits business interest expenditures to amounts of income. Now, of course, if you're a small business and you make the 163 subsection J election, this will allow you to be able to do that. So again, they're kind of talking about capital expenditures here. Does the expenditure provide future benefit? And if so, you have to capitalize rather than deduct. Now, there's certain de minimis rules that happen here. If it's less than $500, you will be able to write it off immediately, even though there may be some benefit that, a very good example, when I bought my first computer for my first CPA firm, I think I spent $300 on it. I went ahead and deducted it because I was like, this is cool. I get to have a business with deductions on it. This with depreciation. This is wonderful. I should have just written it off. It's not worth it. A lot of people get real excited when they, especially accountants, when we have assets and we're going to deduct it because we're accountants. We can track this stuff. Yeah, that's nice, but you don't have to. And as a result of which, it saves you a little bit of time just to go ahead and write it off. Now, if you are a business that reports the SEC, in other words, a publicly traded company, that $500 becomes $5,000, and as a result of the $5,000, anything under $5,000, you write it off immediately. Over $5,000, you have to examine it and make sure that it doesn't fit certain profiles in order to require capitalization. And because if it does require that capitalization, you do have to do that. So deducted benefits is less than 12 months, and benefits do not exceed beyond the end of the next tax year. Very good example. I had a person who bought a computer in November, and I remember the staff that I had that was working on it, this was at another accounting firm, tried to capitalize it. And I said, yeah, but we know that they're going to sell it the following year, which they do. Every year they buy a computer, they use it for about a year, and then they get rid of it, and then they buy another computer because they always want to be on the latest and greatest. I just decided at that point, we're not going to do it. They said, well, yeah, but it goes into the next year. And I said, yeah, but that's because they bought it in November. The benefit, if we know that the person's not going to own it beyond next year, then we would go ahead and capitalize it. But I have it on good faith from the client that they have no intention of changing their policy of buying brand new and getting rid of it. They wanted to impress, and that was kind of the important thing there. So business expense with personal expenses, mixed motive. Mixed motive, a very good example. Now, mixed motive is a very subjective standard. Very good example. If I choose to go to the Las Vegas convention, but maybe they have a similar convention or in Orlando, I didn't have to go to Las Vegas. Maybe I could have gone to Orlando instead. Did I choose to go to Las Vegas for a personal motive? More likely than not, yes. Now, if I'm going there and I'm just doing 100% of what the business requires, in other words, attending the conference, getting my CE, getting all the stuff that's necessary in order for me to maintain my license, then the IRS isn't going to generally question things. Now, again, if you do business travel, say for example, I'm going to the convention and I'm there for a week, and then I spend 4 days after that visiting family and friends, and then I go for another 2 weeks and I decide to go on a trip to the Grand Canyon and go camping. Now some of that business expense is in jeopardy. And this is one reason why when we talk to people about doing their business expenses, we ask them to be extremely careful because we don't want to have a situation where they're causing themselves some problems. Otherwise, so that, mixed motive. Again, there's an arbitrary percentage with some of this stuff. Very good example is 50%. And the IRS's motive on that is, look, if you didn't have a business motive to eat with that client, you'd still eat. So there's a portion of that we're just going to say it's arbitrary. 50% for meals is generally the deduction that's allowed. There is a 100% deduction for meals allowed under certain circumstances. Those are going to be for convenience of the employer. Very good example. You work during tax season, and so what ends up happening is You're, very good example during tax season here. I told my employees I needed them to stick around a little later tonight. I said, look, if you stick around, I'll buy you dinner. That way you don't have to run out and go get your food and then come back. That was at my convenience because I needed them in their desk in order to pound out tax returns. So I go out and I buy them pizza, 100% deductible. Okay. There could be a basis for allocation. Very good example is mileage or time. In my example where I go to Las Vegas and I spend a week in Las Vegas attending the business event, and then I spend 4 days with my family and 2 weeks with the other thing, I can use that time allocation in order to say how much of this was really business and how much of this was personal. Record keeping, document business purpose. Oftentimes this is the part of your internal accounting department and a requirement in order to be able to do. Not going to talk about that. Business limitation, we talked about this. If he has $25 million or less for the previous 3 years, and that's average. So if you have 1 year that spikes to 25 million, and then the other 2 years are sufficiently low enough that all three averages out to being less than 25 million, you don't have to worry about it. Okay. Business interest deduction is limited to business interest income plus 30% of the adjusted tax income. In other words, what they do is they take your tax income, they remove the business interest, they take 30% of it, and that's what your business interest deduction is limited to. Again, you're not going to have to think too much about it. The system's going to do this for you. Now there could be some exceptions to the rule, but you're pretty much going to do what that does. The adjusted taxable income allocated to business computer without regard to these items, and so that's what they end up doing. Yeah, as I said, they take out interest. They also take out depreciation, any business income not allocable to trade or business. All right. Accounting for taxable income. Again, we've learned to identify business gross income and deductions. Now we need to match them to the specific period. So there's two ways that we actually do this, and we either do it as a calendar year or a fiscal year. Now, calendar year, of course, ends 12/31. I don't think I need to explain calendar year to anyone. Fiscal year depends on choice. So it's the last day of the month. Obviously not December, because if it was, it's a calendar year. But so, for example, if I say we're going to have our fiscal year run through May, it has to end May 31st. You can't arbitrarily choose May 15th or May 1st. Can't do it. Okay. And I'm talking about from a tax perspective. You can do whatever you want on financial. Now, of course, if you have a different financial end of year and a different tax end of year, you are going to make your accountant's head explode. Probably a good idea to make sure everything lines up. So that's usually what we'll end up doing. So proprietorships is the same as the proprietor's year end. That's usually not hard to figure out. You can try to do an election, but you got to get IRS permission. They're almost always going to say no. I've only heard of once or twice, and usually if they do, they require that the individual has to have the same to end of year. And I have actually seen clients. It's not like pink unicorns. It's more like a black bear. Not only do I've seen one, but I don't see one frequently. I don't live in South Dakota anymore, so I don't see black bears as often as I used to. But again, proprietorships generally going to be the same year as the end of the year of the client. There are clients who can elect a different year, and if there's a reason for them to do it, usually these are guys who have a proprietorship that's pretty significant, and they say, look, most of my business income arrives in April. For example, if I'm a CPA firm, most of my income arrives in April or May, so I'm going to make the end of May by the end of my fiscal year. And they'll let you do it, but then you have to take your entire thing and put it there. Now, again, your tax preparer's head's going to explode if you do this, because everybody puts everything else out in calendar year, so I mean you're always going to be calendar year. So now you have to kind of split the difference in order to be able to figure it out. So it is a difficult thing to do. Now, with spreadsheets, we can solve this problem pretty easily. It's not a big deal anymore as much as it used to be. C corporation individuals, choices made first tax return and is consistent with the accounting or the book accounting period. Flow through entities, a required tax year. Again, it must match owner's principal period, multiple of owners. It can be complicated. So what will happen is Say, for example, you have a partnership, and we'll say it's a partnership that's owned by 3 corporations. 2 corporations are on calendar year, and 1 corporation is on a government year, so they end the year on 9/30. What's going to happen? So there's certain rules that you have to follow in order to be able to pick that out. I think we go through that here later on. Financial and tax methods. Financial accounting is conservative. GAAP is slow to recognize income and quick to recognize expenses or losses. Tax accounting is less conservative for obvious reasons. If we, think of it this way: from the tax perspective, I'm slow to recognize income, but I'm fast to expense things. The IRS would never get any money off that. So it's the goal of Congress is to maximize tax revenues using a fair and level playing field. Now, I know that saying something is fair and level playing field is a very dangerous thing, because I know I'll get a lot of arguments out of that. However, that's kind of what Congress is trying to do. They're trying to do it based off fairness. When I say fairness, I don't necessarily mean that people don't get screwed. People get screwed all the time. Congress can't pass a law to stop that. It's just impossible. But by taking the processes of the republic, and I didn't say democracy because we're technically not a democracy, but again, this is not a poli-sci class. But America is actually a republic. But using the republic's process, we try to take as many best interest, the interest of most parties involved into account in order to make good policy. Now, again, is it pretty? No. Does it always work? No. I'm not saying that, but I'm saying that's the goal and the ideal of a Republican government. Financial accounting, again, the objective is to avoid misleading investors. Again, the Congress is to maximize tax revenues. So there's 3 permissible methods. You have cash, accrual, and hybrid. I've been doing this for almost 20 years. I think I've only seen 1 hybrid in my entire life. You're not going to see very many hybrids. They're going to be cash or accrual. First of all, most accountants don't want to think about this any more than they have to. Cash, the reason why we're going to do cash, especially if you're one of those businesses that you bill people out for stuff and you got to wait till they pay you the cash, you don't want to pay taxes on income that you didn't recognize. So you've got to be able to figure that type of stuff out. The accrual, recognize income when it is earned or received, generally whichever is first. Again, it's a very good example of when that's not going to be the case, that if you get the cash ahead of time and it's a prepaid income expense, you're not necessarily going to record that as income immediately. So methods are adopted with the first tax return. Large corporations and partnerships with corporate partners must use accrual. And part of the reason for that is they don't want any funny business. They don't want you using this isn't a method in order to maximize your benefits. It's a method for you to ease compliance. If you think about it, why would cash method be allowed? Well, think about it. Most people, that's exactly how we do it. I got cash that comes in. You don't sit there and say, well, gosh, I'm going to finish my pay period on the 15th. I get paid on the 20th. So I'm going to say that I got my income on the 15th and not on the 20th. Nobody operates that way. You can't pay your bills that way. Now, and believe me, some of us will try. But when we have the power bill calling us up and saying, "Hey, you haven't paid your power bill for this month," they say, "Yeah, well, I have the income, but I don't have it with me." It's almost like Han Solo all over again on Star Wars. I have it, but I don't have it with me. Okay, that's the thing. You've earned the money. You're supposed to get it, and that's how that happens. So for most small business taxpayers, cash is a very smart way to do that. Now, accrual, if you have an accounting department that's helping you out, accrual is actually easier. I did an accrual basis taxpayer. I mean, it's relatively simple. There's only like 1 or 2 tax journal entries normally for non-deductible business expenses, and that's it. They're actually much easier. Cash, you have to do your cash to accrual conversion and your accrual to cash conversion in order to get that sort of stuff done. So again, pros and cons. It's flexible, simple, relatively inexpensive, poor matching of income expenses. Can be used by taxpayers with an annual average gross receipts of $25 million less. You start making more than $25 million, the IRS says you better go hire a CPA. You better go hire an accountant because you should be able to do this. Okay. Accrual income. If you're in this program, you know what accrual income is. I'm not going to waste your time on it. Accrual prepaid income. Allowed to defer recognition for 1 year unless income is earned or recognized for financial records. Um, Not applicable to payments related to rent or interest income. Again, what does this mean? Allowed to defer recognition for 1 year unless income is earned or recognized for financial purposes. What that means is, and I have a client now who he actually received a payment for some goods that he bought ahead of time. Now we're talking about to the tune of about $2 million. A lot of income that he's gonna have to pay tax on that he didn't get the cash yet. He still hasn't gotten the cash. I mean, we're in almost May. He still hasn't gotten the cash yet, so he can't pay the taxes on the income that he's earned. So, and actually, technically, he hasn't earned it. It's a prepayment that he demanded up front in order for him to be able to do the things he needed to do. So what happens is the way the journal entry goes is cash debited, prepaid income credit. So it's a liability, and it's again, you can defer it for 1 year. And now in my client's case, he'll definitely be good once this coronavirus gets over with. Inventories must be accounted for under the accrual method if sales is constitutes a material income producing factor. So taxpayers with average gross receipts of $26 million or less can opt to treat cost of goods as non-inventory. Generally speaking, that's, well, most of my clients do it. They take purchases. They want to be able to deduct everything immediately. I usually force them to do some inventory. And actually, in one case with one client, it actually helped his loan go through because they noticed he actually had inventory. They were impressed with that. So it actually helped out. UNICAP, these are the kind of the rules that we had talked about. Inventory under UNICAP must be accounted for using a full absorption rule. Indirect costs are allocated inventories, not expensed. Cost of selling, advertising, and research need not be capitalized. And then exception for small businesses, you don't have to follow UNICAP rules if you're under 26 million. Inventory assumptions. Generally speaking, they're going to do FIFO. FIFO is going to be your thing. Very rarely will they do specific identification. LIFO's going the way of the dodo. It's been going the way of the dodo for many years. And for those of you who don't know what a dodo is because of age, dodo bird is a bird that was extinct probably about 100 years ago. Although I thought they said they found one in Africa, which I thought was kind of interesting. But basically, LIFO's going away. A lot of times, some companies like Ford Motor Company were using LIFO for many years. It complicates things. It's not, the IRS doesn't want you to use it. And as you probably remember when you took your financial accounting class, problem with LIFO is it undervalues your inventory significantly. But it's a way that you can actually reduce income as a result of that. So there's a lot of stuff with that. All events have to occur to establish blah blah blah, economic performance. Economic performance, we talk about this a lot. It applies to an accrual method taxpayers only. Again, taxpayer using property or goods. Payment liabilities are performed only when paid, and interest and rent occur ratably. In other words, with interest and rent, because we call those FDAP, fixed and determinable payments, FDAP. That's why we tend to use the fixed and determined ratably. Fixed and determined payments, FDAP is also used a lot in international accounting. There's special rules that happen with FDAP payments that we kind of have to do. Liability and economic performance, so Code Section 461. You have to capitalize if it's more than 12 months. If it's less than that, you deduct under 162. Okay. Choosing an accounting method. Now, choosing an accounting method sounds more complicated than it really is. Generally speaking, this is a discussion that you want to have with your client when they first set up their business. Oftentimes, the client will come to you and they've already chosen one for you. You can, a permissible method is adopted by using and reporting it for year one. In other words, you don't have to do a fancy form on that. All you have to do is when you fill out the tax return, check the box, it's done. Life is really good with that. An impermissible method is adopted by using and reporting the method for 2 years. Now, some of you might say, wait a minute, an impermissible method? Yeah, well, so what the IRS does is that you'll file the tax return. If the IRS doesn't come back and challenge it, you're allowed to use it. It's one of those few times where, yeah, we know that you're not allowed to do something, but they're going to give you permission to do it because you've used it for 2 years. Now, what will end up happening is the IRS will sometimes ask you to go ahead and make a change anyways, and that brings up an interesting form that I have here. And guys, I'm going to take a quick 2-minute break. I need to go grab one other thing in order to get this taken care of. I'll be back in 2 minutes, and then we'll talk about 3115. Sorry about that, folks. I saw my my other line was going off, and it was from a client that I had to take call from. I've been trying to get in touch with them for a few weeks, and finally reached out. So anyway, so this is form 3115. This form, for the most part, is probably one of the most difficult forms that you will fill out in your tax return years. Maybe with the exception of some of the international tax stuff. But the application, it's basically an application for an accounting change, a method change. Now, you'll take a look at this form, and there's certain things that they have. They have like some defaults. So, for example, you have depreciation amortization, you have fixed financial products, and then you also have this other box. Now, with the other box, there's a whole lot of things that can go onto this form. And there's certain things that you can do but you have to get the IRS's permission. And that's how you do this. You file the 3115, you say, this is what I want to do. This is why I want to do this. And generally they'll come back to you and they'll say, yeah, we'll allow you to do it, or no, this is the dumbest thing we've ever seen. We're not going to let you do it. No, they won't say it's the dumbest thing. They'll just say, sorry, we're not going to allow you to do this. And generally speaking, if you want to move from an impermissible method to a permissible method, it's going to be what we refer to as an automatic change. Now, what will happen is there's these various things, and they're called RevProcs, and it's spelled REVPROC, and I'll show you how it's kind of done. We call them RevProcs, and what a RevProc is that it's short for revenue procedure. Okay. RevProcs are generally submitted out, and basically it's done by the IRS. It's through the RevProc process, and this is a method or a way of doing something. So, for example, Rev Proc number one of almost every single tax year is going to be how to file a PLR, a private letter ruling. So if you want to ask and we haven't talked about this, we'll talk about this when we do the review for the exam and we talk about the research question. There's basically what will end up happening is for the letter ruling. So for example, I had a client who we were going to do a retroactive S election, and we wanted to go back 2 years. And then the client came to me, and actually 2 years is perfectly allowable, perfectly allowed under law. So the client came back to me and said, you know what, Kevin, I really think we should have gone back 3 years. And I'm thinking to myself, oh my God, what the hell am I getting myself into? This client wants to go back 3 years. And I tried talking her out of it. I said, it's not a good idea. You don't want to do this. I said, it's going to be expensive. But she asked me, if I did it, how much are we going to save? And when I did the calculation, I knew I was dead in the water because I told her she was going to save $25,000. There was nothing I was going to do to stop her from doing the Rev Proc, for trying to do a letter ruling to do this. So, and that's what's required. If you want to go back more than 2 years, you have to do a letter ruling. And basically, you have to prove to the IRS, number one, that the IRS isn't going to get hurt on this. And then number two, you have to prove that that it was that the reason why you didn't do the S election was something that was out of your hands. Now, in her case, it was. The previous CPA, she had asked for tax advice on how to reduce taxable income, and they had talked with her about doing a C corporation, which back then the C corporation tax rates were 35%. It was ludicrous. Basically, the reason why the CPA did this is that they didn't want to do the S corporation work because they were going to, and I don't know if it was about money. I don't know if it was about time. I don't know if it was because he was incompetent and didn't want to deal with it. Doesn't matter. He decided he didn't want to do it. And so he didn't give it to her as an option. And in fact, when she first was looking around for a new CPA because she didn't think she was getting good tax advice from him, she asked me about what would you do? And I said, you're making about $500,000 as a consultant. I don't know why you're not an S corporation. And she's like, what's an S corp? I mean, that right there should say, if her previous CPA was doing anything, she should have at least been told about it. Now, I will tell you, I've come to the realization that a good majority of my clients are told things by their CPAs and they completely forget. I mean, that happens. I mean, we're all human. But at the same time, she ended up actually hurting herself because she was not given this. So we were able to go to the IRS and say, okay, we filed a letter ruling, followed Rev Proc number one. It was actually 2019-1 and that's how they'll do it. So like for a very good example of it will be, and I'll say Rev Proc 2019-01 is pretty much how it will go. That's how you'll see it being referenced. And so we ended up contacting them and doing a letter ruling. So it's not impossible to do letter ruling. Now, it has nothing to do with 3115. But sometimes what will happen is there's certain things you have to get permission on. But the IRS has used the Rev Proc to already say, look, if you want to move from this method to this method, you can do that, but you're going to have to file a 3115. And oh, by the way, at the top of the page, which means right here, we want you to put in Rev Proc, 2013-84, for example. That way, when the IRS change of accounting method division gets this, they'll take a look at it and they'll say, oh, this is the Rev Proc they're pulling up. This is what I need to know in order to be able to do it. You're helping them out. And actually, this actually helps them out, makes things a little smoother. The one thing you do not want to do, you don't want to make things harder on the IRS when this is the case. They are your friend in this case. They'll let you do things that are permissible in order to get things done. Now, there's certain things that are automatic. Very good example. Oftentimes what will happen is I'll get clients who own rental properties and they don't want to do depreciation because they're told that if you do depreciation, you have to pay extra tax at the end. It's not true. They're going to lose that opportunity for a deduction. But what'll happen is that we'll say, okay, we're going to move you from an impermissible method, because not taking depreciation is actually not allowed under the rules. You have to take depreciation. So you've done zero depreciation, which is an impermissible method, to a permissible method, which allows you to have the depreciation. So I check this box. It's automatic. I put up the relevant rev proc in order to get that done. I would pull one up as an example, but of course I'm not going to show you guys client data. But there's, I guess I could take theirs and just muff out all the stuff that needs to be done. But anyways, so there's this thing, part one, for an automatic change request. There's going to be certain things that they have. They'll say the designated automatic change method. There's a DCN that they'll give you. You put that in as part of the automatic change, and it allows them to kind of speed these things through. Then there's information part two, which is information for all requests during the tax year, blah, blah, blah. And then you go to the next page. Now you're going to begin to realize why you don't like this form. All in all, there are 8 pages to this form. And there's a lot of yes, no questions. And you got to go through each one of these and make sure that it all happens. Very good example. 6A, does the applicant or have any tax returns that are being under examination? If the answer is no, you skip to 7. But if they are, you need to tell them the name of the person and the telephone number of the tax years that they're actually looking at. So you want to make sure that that gets taken care of. Does audit protection apply to the applicant's request to change an accounting method? Now, some of you might say, what the hell is that? Audit protection apply? Where can I go buy that? No, you don't buy it. Audit protection basically is when you've gone and asked the IRS for permission to do something, and they say yes, that gives you sort of a protection against being audited for that, because the IRS told you, they gave you permission to do it. So if it does, you'll say, does audit protection apply to the applicant's request to change method? We say the answer is yes or no. It says, if no, attach an explanation. I can't remember what explanation I used the last time I did this. If yes, check the applicable and attach the method. So not under exam, audit protection at end of exam, the 120-day rule. We can talk about various things about this. I've only got about 4 minutes left, so I don't want to hit all that boring stuff. There's a certain thing here they'll say. There's a portion I really wanted to. This is the non-automatic. Okay. This right here is section 481A, subsection A adjustment. What does that mean? What's the overall financial effect on this? So, for example, if I go from an impermissible method for depreciation, say I've never taken depreciation before, and all of a sudden I want to sell the house and I'm going to take depreciation, which is an automatically accepted process. What do I need to do? What'll happen is I'm going to take depreciation that I didn't take in previous years. So it's going to be an expense that I previously didn't take that I'm going to take now. So what's going to happen is I'm going to have a huge negative item in here, a minus number that goes onto this. And that's your section 481 adjustment. And the way I've done it in the tax return, usually this happens with me on rental properties. Person never took depreciation. We fill out a 3115. I charge them $950 for making me do this. And then on top of it, we put in the income tax return, how much so say, for example, I come up with a number of, $120,000 of depreciation. That's a negative $120,000 that goes on their tax return. And yes, I have had a tax return that did have a $120,000 section 481A adjustment, because they own the rental property for 20 years. They never took any depreciation on it. We put that number in. I was able to back up all the data. I had everything ready. I was waiting for an IRS audit on this. It didn't happen. It was actually one of the few times I was disappointed an IRS audit didn't happen. I was looking forward to it. So I was going to be, I'm going to walk right into the office and say, here's this tax return, that tax return, that tax return, that tax return. And by the way, here's a spreadsheet on how we calculated it. Prove me why I'm wrong. And I was so looking forward to it, but it didn't happen. And I think part of it is because if it smells right, the IRS just kind of doesn't look, they just look the other way. So then they'll tell you how much the income either increases or decreases. This number also goes on the tax return as a negative number that gets done. Is the applicant electing to take the amount of the adjustment in the year of the change? If yes, mark the box applicable. So here's what happens. If it's under $50,000, you can take the automatic immediately, and you can take, because normally you're supposed to take it over 4 years. You know, basically, but the negatives usually you're allowed to take in the immediate year that it happens. Now, what'll happen is that if you don't want to take it over 4 years, you can take, if it's under $50,000, you can just check this box and you take it all 100% in the first year. Eligible acquisition transaction election. So if you are purchasing this property or disposing of it, there's a way that you can actually take that immediately as a part of that. Generally speaking, you're not going to do that. You're going to want to take this over 4 years. I've never seen a situation where it made more sense to take it immediately. Now, the expense you take immediately. IRS doesn't want to be dealing with expenses over the next 4 years. Okay. And then overall change of method and change in reporting long-term contracts. So there's a lot of stuff that goes into this, and there's a lot of times you're going to fill this form out. There's a lot of this is going to be blank, but you have to go through the entire form. That's why I don't charge anything less than $950. In fact, starting at the end of this year, we're going to start upping that charge to around $1,500. We won't touch this for less than $1,500 because it's an expensive form. It takes a lot of time to fill out and everything. All right, folks. We're at 8:45. I'll ask one last time. Any questions? I'll shut off recording at